Ladies and gentlemen, welcome to the second edition of St. John's Northwestern Academy's Financial Series, a program that we've developed over the course of the last couple of months to take financial matters, mostly specific to charitable giving, and bring information to you as easily and convenient as possible. We're joined today by Mark Henry, an attorney, CPA, an author of a book called Finish Faithful. And we are going to pepper him with a handful of questions in regards to end-of-year giving and all that it entails. I recently had a conversation with someone in regards to this topic, and I feel that though this topic is probably more applicable to everybody, as many know, December is a very active month for charitable giving, and so I appreciate, Mark, for you taking your time to be with us today and share some of your experience. So welcome.
My pleasure. I appreciate the opportunity to, as we get towards the end of the year here, to share some tips with your friends and supporters. So let's get started.
Fantastic. So let's set the table here for the next slide that we're talking. So we're at the end of the year, and as many know, 2020 has been a year of change, challenges, and the end of year charitable giving tax implications are no different. So can you dive into the Secure Act, the CARES Act, what the election might bring moving forward, and how this all plays into this the next 6 weeks here?
Yeah, we have had a lot of changes in 2020. Not just concerning the tax code, but all kinds of things. I know a lot of people would just as soon put the year behind us, but every year as we come towards the end of the year, it's a great opportunity to do some last minute tinkering with the finances and take advantage of some of the recent tax laws and also look forward to the future. While the political election is still kind of up in the air, we can start seeing some possible trends if Biden is the new president. There's some fairly predictable changes that have been, they've floated them up the flagpole, and it's pretty likely that there'll be some changes in income tax and possibly estate tax. And then there's always a few time-tested legacy planning strategies which people can put into place before the year end and nail down those charitable contribution deductions, because we do not know what's going to happen in 2021. So with that high-level overview, we can kind of dive into the details with the next slide. So one of the big changes was the Coronavirus Aid, Relief, and Economic Security Act. What a mouthful. But it is a tax law change that a lot of charities, were really hoping would happen. And some of them benefit, mostly low and middle income households, while others benefit higher income earning households. The biggest change that most people have heard about is that there's a $300 deduction for charitable gifts, which most people will be able to claim even if they don't itemize. In the past, it's been difficult for folks who don't have higher incomes to take advantage and get a charitable deduction. Well, this year, you'll be able to deduct $300 regardless of whether you itemize or not. But the bigger change really is the lifting of the cap on the deductibility of contributions. It used to be that 60% of AGI, your adjusted gross income, was the maximum you could deduct for a deduction. And the CARES Act eliminated that cap entirely for 2020. So essentially a donor can deduct, up to 100% of their AGI this year. And likewise with businesses, the new law also increases the limit on charitable contribution deductions from 10% to 25% of a corporation's taxable income. Now, there are a few caveats. I mean, what's the tax law without exceptions and caveats? And, one of the caveats is that, these increased limits apply to cash contributions only, and they do not apply to gifts to donor advised funds. And, eliminating the AGI cap is going to benefit charities this year since it will essentially encourage people to accelerate their deductions and get them, taken care of before year end. And so that's an important year end tax planning strategy. But, the bottom line is that these tax law changes benefit primarily wealthy donors who are going to benefit by being able to deduct 100% of the contributions instead of being limited to 60%. But, the CARES Act isn't the only change. The Secures Act was implemented, and that is the Setting Every Community Up for Retirement Enhancement Act. And as the lengthy title suggests, it pertains to retirement planning. And it really is probably the most significant change in retirement and pension planning since 2006. And without getting into all the details, there are three primary changes in place as a result of the Secure Act. Required minimum distributions are kicked off down the road. Used to be once you reach the age of 70 and a half, you had to start taking those minimum distributions. Well, that's been deferred, and you don't have to take those distributions until you reach the age of 72. And you can also continue to deduct contributions to your IRAs after the age of 70 and a half. If someone's earning a high income and they decide they're not going to retire, they can continue to contribute to their retirement account even after the age of 70 and a half. And another big change involved what used to be called the stretch IRA. When people inherited IRAs, they could, instead of taking the entire amount of the IRA in the year of inheritance, they could stretch out the distribution over a 10-year period. That was a common go-to estate planning strategy that would reduce the tax bite on folks who inherited an IRA from a parent or such. Well, that's been changed. And now inherited IRAs, the beneficiaries have to take all of the distributions within a 10-year period. So, that basically makes it such that, IRAs, again, continue to be the most heavily taxed of all assets. And if folks are going to consider charitable giving, they should definitely begin with the high tax IRA and pension retirement benefit assets, because those are the assets that are going to get hit hardest when people do their estate planning.
Mark, if I can jump in real quick, just a couple of questions on this. So with the CARES Act, is there, with these added benefits or new policies, is there any motivation for individuals who were either non-itemizers or were itemizers to kind of jump and change between, from previous years to this year because of these new changes in the CARES Act?
Yeah, well, across the board, it's incentivizing people to give, regardless of whether they are itemizers or non-itemizers. And it was a reflection of the fact that, nonprofit organizations were probably the hardest hit organizations as a result of economic shutdowns and such. So they decided to liberalize, the contribution incentive for both low income and middle income as well as high income. Now, is that going to continue on, for a period of years? Well, we just don't know. What Congress giveth, it can taketh away. And who knows, what the mind frame of Congress will be with a new presidential administration. So the safe thing to do is to really go ahead and accelerate your charitable contributions so that you can protect your tax deduction this year, and then take a second look at things as we get into the new year.
So we're moving on to the next slide, which you teed up very nicely into possible future changes for next year. You want to dive into a little bit of what has been discussed should we see a Biden administration?
Yeah, well, we're getting into the area where the crystal ball sometimes gets a little foggy, but I'll do my best. Under a Biden administration, and it's been this way various times over the last 30 years, I have to say the federal estate tax is the most frequently changed tax law on the books. And, there's always a populist sentiment to sock it to the rich. And even though the estate tax tends to not generate that much in the way of taxation, it's an easy target for a new administration to go after. It seems to be kind of a popular change, but, by and large, the estate tax hasn't been much of an issue for many, many years now. Right now, the estate tax exemption is upwards of 10 million. There's some talk under a Biden administration that would be dramatically reduced. And, over the last 25, 30 years, the estate tax exemption has been as low as a couple $1 million. And, what the exemption means is that if you have, let's just say that the estate tax exemption is reduced to $2.5 million. Well, if you have a total net estate after you pass away of $3 million, the estate tax exemption reduces the taxable estate so that the residual $500,000 or $3 million minus $2,500,000 is going to be subjected to the estate tax. And sometimes there's also estate inheritance tax, although that's not all that common. But either way, under a new Biden administration, I'd have to say that, reducing the estate tax exemption so that more estates will be taxable is probably more likely than not. And then there's also most likely going to be some changes in the charitable contribution taxation. Most prognosticators are thinking that, under a Biden administration, there's going to be less generous charitable contribution deductions than there are right now. So that again points to the wisdom of, if you're considering, a charitable gift, well, might as well do it while you know what the tax laws are so that you can count on getting a certain amount of a tax benefit from it.
Gotcha. So so we have the year-end opportunity.
So again, there are different ways of taking advantage, of year-end tax planning. Sometimes folks are getting involved in sales of businesses. Maybe they have, a rental piece of property that they want to get rid of. They're concerned about the taxes. Well, still in 2020, we have the ability to calculate what the capital gains tax would be. And so if you have, major appreciated assets that you are considering changing due to lifestyle changes, it makes sense to make those changes to sell an appreciated asset, whether it's real estate, whether it's stock, whatever kind of appreciated asset it is. It makes sense to do some tax planning before the end of the year, because next year we just don't know what's going to be coming down the pike. And so there are different ways that you can take advantage of that, and we will spend a little bit of time getting, into the details. One of the more common ways, of course, is the charitable gift annuity. And, that's a strategy which is part income enhancement, part estate planning, part philanthropy. And it's very common in this day and age. The charitable gift annuity can pay people who participate in a gift annuity a much higher rate of income than they're getting off of, say, passbook savings or CDs. Another useful planning strategy is to look at your IRA. And even though the mandatory distribution provisions for IRAs have been deferred, for those folks who are over 72, 72 and a half, they're still going to have to take those IRA distributions. And, the IRA is great while you're at a high income, and you need those deductions. But when your income drops off and then you start taking distributions from the IRA, well, that's when you have to pay the piper. That's when the taxes become an issue. So oftentimes folks will be interested in, instead of taking, the full amount of their required minimum distribution from their IRA, well, you can say give 25% of it or more, to a charity. And what that does is reduce your income tax by during the year you take the distribution. And so these are just a couple of different year-end planning strategies, which, folks may consider while they know what the current tax law provides. But we've talked about the gift annuity, at various times. I think we covered it a little bit in a prior financial series. But a lot of people are curious about the gift annuity because, it's something that sometimes seems to be a little too good to be true. And oftentimes people look at gift annuities because they're looking at their monthly bank account statement and they're seeing off their liquid assets, their savings, they're getting 0.5% to 1%. And that's not even keeping pace with inflation. The bank is making a lot of money off of them because the bank then turns around, loans it out, for 4 or 5%. Well, the gift annuity can provide you a much higher rate of income, and it's a guaranteed income for life. It's not going to change. It's not going to go up and down regardless of how interest rates go or how the stock market goes. And it's also something, that can really enhance your income because it not only increases your income, but it reduces your taxes. Usually for most folks, they're able to get a large percentage of that gift annuity income tax-free for sometimes 3, 4, 5 years. And, one of the reasons why it's partially tax-free is that, well, they call it a gift annuity for a reason. Part of it is a gift. And if you have, say, $100,000 and you put it into a gift annuity and, you get 7% back or $7,000 a year. And I should point out that the rate that you get is going to be based on your age and a couple of other factors. But a portion of that gift annuity income is going to be tax-free, but it also supports St. John's. And so, it's a win-win situation for donors who are trying to, get a higher yield off of their liquid assets. And it's a relatively easy thing to do. Steve, as you're aware, in order to participate in a gift annuity, it's relatively straightforward. The donor writes out a check to the foundation, and they have a 2 or 3 page gift annuity agreement, which basically says, you're going to get whatever the percentage is, 5, 6, 7% for life. And so it's a really straightforward strategy that is popular with a lot of folks. But again, people largely do it because they're interested in increasing their income. The interest rates are at historical low rates right now. And as we can see by this chart here, the rates that you get on a gift annuity are usually 3, 4, 5, 6 times as much as you get off of regular passbook savings and fixed income investments. And, part of the rate factor is based on not only your age, but the American Council of Gift Annuities publishes a rate that goes into the rate calculation. That changes, basically every 6 months or so. And I should also point out that, the gift annuity is available in most, but not all states. It's something that is regulated based on state law, and some states just don't enable St. John's to offer the gift annuity. But the good news is that it's available in most states. So how are we going so far, Steve? You keeping up here?
You're rolling.
Okay. Well, another helpful thing to consider before you get to the end of the year is, your retirement account planning. And of course, IRAs are very popular. Most folks have IRAs, and they do it because it helps them sock away funds for a rainy day for retirement later on. It's something that is very attractive because when you make contributions to the IRA during your income earning years, it's deductible, reduces your taxes. But of course, the rub occurs later on after you retire and start taking distributions. That's because the distributions are going to be taxable to you. And another big factor is because those distributions are taxable, oftentimes people defer taking distributions from their IRA because they just don't like to increase their taxes. And oftentimes when people pass away, the biggest asset in their estate is that IRA that they never fully took all the distributions from. And when you have an IRA or pension plan or other retirement asset in your estate, well, it is oftentimes the most heavily taxed asset in the estate. And so that causes a lot of people to look at different types of planning strategies to reduce the tax bite. Again, they usually don't take a look at this until later on in life when they start realizing that, it doesn't benefit them or their family or their particular cause all that much to pay taxes. And what can they do to reduce the tax bite? Well, it's relatively easy to do. If you're looking at estate planning, you can name St. John's as a partial beneficiary on your IRA. And when the IRA is distributed at a later date after you pass on, the portion that's going to charity is not going to be exposed to income or estate tax at all. And, making a change in your beneficiary is a relatively easy and straightforward thing to do. We've helped St. John's beneficiaries with this before. Oftentimes, it's just a matter of going to the bank's or investment house's internet website, getting their IRA beneficiary change form, and making the change there. And people oftentimes do that as well if they want to reduce their current income tax bite, because every time they take a distribution from their IRA, they're going to be paying taxes. So you can also do some close year-end tax planning, which reduces your tax bite and allocates a portion of your IRA to charity. So again, it's a relatively easy thing to do. When folks are considering, estate planning and looking at different ways where they can provide for their family and also reduce their taxes and provide for their favorite charity, the IRA is a good starting point. What you want to do with family is pass on to them the non-taxable assets. We call those the good assets. And those assets, when they are inherited by family, are not going to have a built-in income tax liability. Whereas the IRA, if that's passed on by way of inheritance, a big percentage of that is going to be lost to taxation. No one likes that. So that's one of the main reasons why when people are considering charitable gift planning, they look first of all at those bad assets, the taxable IRA assets. And if that's something that you want to consider, we'd be happy to help you with. But by and large, it involves getting the IRA beneficiary designation form, from your investment broker, your financial planner, filling it out. It's a good idea to check with the charity, make sure you have the right language, the right tax ID number. And it's also a good idea to make sure that if you make a change to your IRA beneficiary designation form, that you also make a similar change in your will or trust, just to make sure that people realize that you made a change to your retirement asset beneficiaries. Well, we're coming up close to 7 o'clock here.
Right.
And so now's the time when I sometimes field questions from those who are joining in with us here. But we also want to make sure that folks have the opportunity to have their questions answered. We're happy to make copies of this presentation and send it to you. And if you have any questions concerning how you can, do your end of year tax planning and perhaps invest in a charitable gift annuity or reduce your IRA taxes, well, the best thing to do is to circle around with Steve. He's available to take your call, or you can email him with your questions, and then I'm available to actually help people implement their different planning strategies. Having said that, I appreciate the opportunity to share with you on end-of-year tax planning strategies, and I look forward to the opportunity to answer any further questions if any of you have questions which we didn't address during the presentation.
All right, ladies and gentlemen, I don't see any questions that are popping up, but as Mark had concluded, that should you have any questions that come up, feel free to submit their questions. My contact information is up there, smats@sjma.org, or my newer email address, smats@sjnacademies.org. Also my direct line at the Academy, 262-646-7184. I want to thank Mark very much for his expertise in going through topics of IRAs, CGAs, the 2020 tax changes with the CARES Act and Secures Act. Thank you so much for your participation, and you have yourself a happy Thanksgiving. And we'll circle back with us after the end of the year. We will have another episode of SJNA Financial Series. Thank you so much. Have a great night.